Hello everyone, and welcome to today's presentation. I'm excited to share with you our analysis on a Connecticut high-income surtax proposal. The title of our presentation is Connecticut High-Income Surtax Proposal. Over the next few minutes, we'll explore different surtax scenarios, specifically 2%, 3%, 4%, and 5%, and see how they might generate revenue and support education funding. We'll be using the latest IRS SOI data for high-income filers to inform our analysis. Let's dive in and see what these options could mean for Connecticut. Let's take a look at Connecticut's current tax landscape. The top marginal income tax rate here is 6.99%, which is relatively moderate compared to some neighboring states. But it's important to note that high-income households tend to be concentrated in just a few counties, which means the tax burden can be quite localized. When we compare this regionally, Massachusetts has a top rate of around 9%, and New York exceeds 10%. So, Connecticut's rate is lower, but the wealthier households in our state are still facing significant taxes elsewhere. Now, our proposal is to introduce an additional surtax, but only on income exceeding $400,000. This approach targets higher earners without impacting middle-income families. It's a way to generate revenue while considering economic fairness. This fits into the broader policy discussion about balancing revenue needs with maintaining competitiveness and supporting economic growth across the state. In 2022, there were about 35,000 Connecticut filers who reported an adjusted gross income, or AGI, above $400,000. That's a significant number of high-income earners in the state. Altogether, these filers reported roughly $47 billion in total AGI, which highlights just how substantial their income contributions are to Connecticut's economy. Now, for our analysis, we're focusing on the excess income beyond that $400,000 threshold per return. This is important because it forms the basis for calculating the surtax, essentially, the additional tax we want to understand and potentially implement. By isolating this excess income, we can better assess the impact of a surtax on these high earners and how it might contribute to the overall tax revenue and economic fairness. This data gives us a clear picture of who the high-income filers are and sets the stage for discussing how targeted surtaxes can be structured to address income inequality and fund vital public services. Now, let's walk through the steps for calculating the surtax impact. First, we determine the excess income by subtracting $400,000 multiplied by the number of returns from the adjusted gross income, or AGI. This gives us the amount of income that exceeds our baseline threshold. Next, we apply the surtax rates, starting at 2%, then moving to 3%, 4%, and 5% to that excess income. This helps us see how the surtax affects different income levels. Finally, we compare the projected revenue generated from these surtax rates with the overall effective tax impacts. This comparison is key to understanding the potential revenue and the tax burden on high-income taxpayers. Overall, this methodology provides a clear, step-by-step way to evaluate how surtax rates influence both government revenue and taxpayer obligations. Let's look at the revenue projections based on excess income. Currently, we're estimating an excess income of around $33 billion. Now, to give some perspective, if we take a 2% share of that, it amounts to approximately $660 million. Increasing that to 3% brings us to about $990 million, and at 4%, we're looking at roughly $1.32 billion. For a more balanced outlook, a mid-range expectation of around 4% suggests an annual revenue of about $1.3 billion. These figures highlight the significant potential income that could be realized, emphasizing the importance of these projections in our overall strategic planning. As we look at this chart, you'll see how revenue grows in a steady, linear fashion as surtax rates increase. What's really interesting is that for each additional percentage point we raise the surtax, we're generating roughly $330 million more in revenue. That consistent increase highlights how predictable and reliable this source of income can be. Another key point is the stability of this revenue stream, largely thanks to the high income base. Because the wealthier segment tends to be less sensitive to small rate changes, we see relatively stable results across different surtax levels. All of this ties back to our overall goal of creating sustainable, predictable revenue. Visualizing it this way helps us see just how effective incremental surtax adjustments can be in supporting our fiscal objectives. Let's take a closer look at Connecticut's effective tax rates. The baseline top rate in Connecticut is 6.99%. However, if we add a 4% surtax, the effective rate rises to approximately 8.5%. When we compare this to neighboring states, Massachusetts has a top rate of 9%, while New York ranges from about 10 to 10.9%. What's important here is that Connecticut remains regionally competitive in terms of tax rates, even after increasing revenue through this surtax. This balance is crucial because it allows us to raise the funds needed without losing our competitive edge. Overall, this comparison highlights that Connecticut's tax structure is designed to be both effective for revenue purposes and mindful of regional competitiveness. It's a strategic approach to maintaining a strong fiscal position while supporting economic stability in the region. Let's talk about the potential economic impacts of this initiative. One of the key points is that the annual yield generated could be used to fund important programs like education grants and early learning initiatives. This means that the revenue we generate isn't just a number, it's a direct investment in our community's future. However, it's important to keep in mind that the overall economic impact depends heavily on how high earners respond behaviorally. If they change their spending or investment habits in reaction to this policy, it could influence the actual outcomes we see. For our analysis, we've made some assumptions. Specifically, we haven't factored in large outmigration or avoidance effects. That is, we're assuming that people won't be leaving the area or avoiding it due to these changes. All in all, the economic and fiscal impacts of this policy are promising, especially when considering the potential to reinvest in education and early childhood programs, which are vital for long-term community development. All right, let's talk about the assumptions and limitations behind our projections. First, we based our analysis on the IRS SOI 2022 data, which serves as our baseline. That means all our estimates start from the most recent comprehensive data available. It's important to note that we did not model any migration or tax avoidance behaviors. So, the projections assume that people's location and their tax strategies stay constant, which simplifies the analysis, but also means it doesn't capture some real-world dynamics. Additionally, our projections use a static income distribution. In other words, we're assuming income levels remain the same over time, without accounting for potential shifts or growth. While this makes the model easier to handle, it's a simplification that limits how much we can say about future changes. Overall, these points highlight that our analysis is based on certain assumptions for simplicity, but they also introduce some limitations in how precisely we can predict future outcomes. It's a balance between clarity and complexity, and it's important to keep these factors in mind when interpreting our results. Now, let's look at the potential financial impact of the surtax. A 2 to 5% surtax could generate between $0.7 and $1.6 billion annually. That's a significant amount of revenue that can be specifically dedicated to education and workforce development initiatives. By investing in these areas, we're not only supporting individual growth, but also laying a foundation for long-term economic growth and greater equity across our communities. In conclusion, investing in education is essential for building a stronger, more inclusive economy. It's about creating opportunities for everyone and ensuring sustainable progress for the future.